Every mathematical assumption regarding patterns of token removal is violated by the recent destruction event. Over the last day, the burn rate of Shiba Inu exploded by 1,196%, permanently wiping off 1.6 million tokens. Reducing supplies gradually isn't what this is. The entire economic basis of this ecosystem is being transformed by this systematic devastation happening at scales. Most holders failed to see the concerted eradication methods revealed by the numbers underlying this burn eruption. Multiple smaller burns added an additional 400,000 tokens or more to the permanent elimination count, while a single transaction burned chunks reaching 1.19 million tokens. There hasn't been an instance of this kind of extreme supply destruction since the project began. The meticulous planning and timing of this fire surge are its most remarkable features. There was no chance of these burns or eliminations being caused by members of the community. These deliberate stock pulls occurred at a time of peak market uncertainty, when consumers were looking elsewhere for their spending money. Expert entities are aware that the best times to burn are when mathematical impact is less acknowledged. When you figure out the rate of acceleration, the mathematical consequences are staggering. Previous cycles of burning were removed. Routine operational procedures generate thousands of tokens every day. The destruction efficiency has increased by a quantum jump, and the supply economics will be substantially changed within hours instead of months, thanks to this 2,196% explosion. On the other hand, most analyses failed to take this crucial insight into account. Such massive spikes in burn rate usually occur 72 to 96 hours before a market generally appreciates in value. Markets ignore the mathematical pressure from big supply removal events until they realize the implications of scarcity, according to evidence from other initiatives with a similar focus. Analyzing the transaction patterns uncovers complex cooperation underlying these burns. It appears that there was more institutional-level organization than organic community participation, as multiple wallet addresses were involved in coordinated deletion activities. This level of cooperation demonstrates well-thought-out strategies for allocating resources and maximizing the effect on supply. The perfect storm for burn effectiveness is being created by current market mentality. During times of low interest and trade volume, retail investors systematically eliminate supply as they fixate on daily price changes. When markets fail to see the mathematical ramifications, optimal burning occurs, according to professional strategists. Instead of advertising burn occurrences for social media attention, the elimination process shows sophisticated tokenomics comprehension. The technical systems in place guarantee the permanent eradication of these destructions, and they occurred covertly, without the need for community permission or coordination. By staying out of the way of speculative trading, this covert method optimizes mathematical impact. The burn explosion is significant, according to token velocity data. Scarcity effects are compounded by reduced circulation velocity and increased degradation, which are underestimated by classic supply-demand models. The price pressure on tokens increases tremendously when they are no longer traded actively, but nonetheless used. Strategic burn deployment, not accidental elimination, appears to be the more plausible explanation given the temporal correlation with larger market conditions. Speculative traders focusing on short-term sentiment indicators seldom acknowledge mathematical advantages. Therefore, professional entities often implement large-scale supply cutbacks during times of market uncertainty. Efficiency and elimination. According to the numbers, this fire explosion had a huge effect for very little money. The ratio of the cost per token destroyed achieved record lows, suggesting that the best time to execute is during price weakness, when it is mathematically profitable to eliminate rather than buy in the market. The mathematical pressure builds up over time due to the everlasting character of these eliminations. Burned tokens permanently erase them, creating scarcity effects that impact long-term price dynamics independent of trade emotion. This makes them different from temporary market interventions that disappear when capital withdraws. Research into smart contracts has shown that these removals are irreversible. There is currently no technical way to retrieve, reissue, or return destroyed tokens into circulation. Because of this permanent damage, scarcity impacts will build up throughout market cycles instead than going away. The strategic ramifications go beyond the basic math of reducing supply. When there is a big fire, it means the institution is confident in the value appreciation possibilities for the future. If an entity doesn't think its remaining assets will appreciate enough to cover the costs of eliminating them, it will not eliminate assets worth millions of dollars. Examination of post-burn trading patterns reveals changes in the market's microstructure. Less stock on hand means smaller order books, which in turn make price changes in either direction more noticeable. Expert traders understand that burn-induced scarcity can boost volatility, which means that those who are well prepared have a better chance of making a profit. Proof of the far-reaching effects of burn occurrences is the psychological toll they have on holders' actions. Discrete math. As holders realize that remaining positions benefit from a reduction in supply, selling pressure usually decreases following major elimination announcements. The mathematical scarcity consequences are amplified by this change in behavior. Projects showing active supply management are preferred over static tokenomics models from a regulatory standpoint on a global scale when it comes to token burning. Systematic burn mechanisms are being seen by regulators as a sign of reasonable economic management, not manipulative speculation, which bodes well for their potential institutional adoption. The underlying tech for these burns demonstrates superior smart contract capabilities compared to most of the competition. Instead of community-based economic policies, professionally managed tokenomics are attracting institutional interest because of their efficient, secure, and verifiable elimination mechanisms. During instances of significant burn, liquidity providers change their behavior as automated market makers modify their pricing algorithms to reflect the decreased supply in circulation. When algorithms are fine-tuned, they may produce short-lived arbitrage opportunities that experienced traders take advantage of while regular people don't notice the shift in the math.